And we're back. Jason Sirois here with Compass Colorado, showing a little bit more skin than usual. These cheeks haven't seen sunshine in quite some time, let me tell you. Okay, we've got some big news in real estate on both the national and the local levels. In this episode, we're going to be talking about consumer sentiment is at an all-time low when it comes to housing, according to Fannie Mae. We have inflation coming down, finally. We're talking about affordability challenges, and last but not least, more days on market means a lot more price reductions. Let's go. Fannie Mae has a national monthly housing survey that is conducted by phone to 1,000 people selected at random. Those folks are asked a series of questions about the real estate market. The answers to those questions are distilled into an index called the Home Purchase Sentiment Index. Now, the most recent results of that survey indicated that the confidence in the real estate market is at an all-time survey low. In fact, only 16% of the respondents said that now would be a good time to buy, while 51% of respondents said that now is a good time to sell. Now, I find these results to be quite interesting and a little surprising. In fact, I would have expected those to be swapped. Right now, buyers hold the majority of the leverage in the real estate negotiations. Now, of course, we have high interest rates, which has priced a lot of people out, I recognize. But there are still a lot of sellers out that are giving massive amounts of credits in order to make the loan more palatable. So yes, on the surface, it is quite unaffordable, as we will get into here in a moment. But it can still be done when the deal is structured the right way. Now, if you're in the seller's seat right now, things don't look quite as great. It's the week of Thanksgiving. Historically, demand is low during this time of year anyways, so my recommendation to you is to hang tight. Don't put your home on the market until after the new year, where we are likely to see a resurgence of demand. With regard to inflation, this is probably the biggest news in real estate right now. After the last Fed meeting about 10 days ago, we learned that the CPI, the Consumer Pricing Index, dropped ahead of schedule, indicating that inflation went from 9.1% in June down to 7.7% in October. This is fantastic news. As a result, the mortgage industry dropped 47 basis points on their average rates, as this graph indicates. So what that means is we went from a 7.08 interest rate to 6.62 overnight, instantaneously. This was big purchasing power increase for buyers. Now, the next Fed meeting is on December 14th. Mark your calendars. If it is determined that we are trending in a direction towards targeted inflation rates, this is going to be an amazing sign, and we will expect to see mortgage rates continue to reduce in correlation. We'll see what that next meeting says. Affordability challenges are the primary reason why home sales have slowed so dramatically over the past several months. Now, it's important for us to understand the components that go into affordability so that we can understand how they are intertwined and affect each other. Number one, mortgage rates. This is the current wild card and primary driver, or even multiplier, of the situation that we are in right now. Now, a general rule to consider when thinking about purchasing power is that for every one whole interest rate increase, a buyer's purchase power deteriorates by about 10%. So if we go back and look at a year ago from now, interest rates were at 3.14% in November of 2021. Fast forward to today, we have 6.64. So this means rates have increased by 3.5% times 10. That's a 35% decrease in affordability. That's a major loss in purchasing power. This alone is why so many buyers have been priced out and pushed out of the buyer pool entirely, which leads me to my next point, home values. The surge of demand for more space, coupled with the sustained low pandemic interest rates, caused home values and inflation to skyrocket. And we can't forget, the Denver Metro appreciated almost 20% for 2 years in a row. That is mega appreciation and certainly not sustainable. And of course, wages would never have been able to keep up with that kind of home value increase. Now, despite 2022 not being a crazy gangbuster 20% appreciation year, this chart that I'm showing, pulled from Redfin, shows the median home values over the last couple of years. Nationally, year over year, we have experienced a 4.9% appreciation while the Denver Metro sits about a full percentage point above that at 5.85% year-over-year appreciation, despite this year being far cooler than the previous couple of years. Now, the third element of affordability is wages. I'm going to read you a quote from a report released from NPR. It states, average wages in October were up 4.7% from a year ago, compared to a 5% increase in September. While wage growth has eased slightly in recent months, wages are still climbing faster than inflation watchdogs would like. Now, it's great to see wages increasing nearly in line with the median home value growth that we've been seeing, as mentioned previously. Now, the downside to this, as the article alludes to, is that increasing wages presses against inflation, which the goal is to slow spending and therefore lower inflation down, which ultimately is goal number one. That all said, the primary driver of affordability is rates. And for our final point, more days on market equals more price drops. The share of homes with price drops is an indication of sellers struggling to attract buyers. Now, the more we have price drops in the market, the more the market is cooling down to favor buyers as expected. Now, we have seen price drops in abundance since June, in other words, since the first major rate hike. Now, this chart, pulled from Redfin, compares the number of listings experiencing a price drop as a percentage, 23.9 nationally, to 4 Denver metro counties, which I added in manually, hovering around 60% receiving a price drop. This is enormous. What I find most interesting though about this chart is the almost perfect spacing between the humps. Each hump represents a year, and you will notice that towards the end of each year, the holiday season, is when we see an uptick in the number of price reductions. What that tells us is that at the end of each year, demand starts to calm as buyers gear down for the holidays. Something else you're probably noticing is that the hump of 2022 is almost 20% higher than the previous years in terms of the percentage of homes experiencing a price reduction. That doesn't come at a huge surprise considering the interest rate environment that we are in and the affordability issues that we are experiencing and just discussed a moment ago. Nonetheless, this is all another indicator that buyers have the edge. To wrap things up, thank you so much for watching. I appreciate you. These videos are a lot of fun to make, and if you're finding any value in this, I would love to earn a like from you right there if you're watching this on YouTube. And then of course, share this with somebody who you think might be interested in learning more about the Denver Metro stats. It is Thanksgiving week. If you are traveling, travel safely. I hope it is full of delicious food and good times and great memories. As always, be well, stay smart, and I'll catch you next time.